Hey option traders, for today's trade we're looking at a long call option in Dick's Sporting Goods stock, the popular sporting goods retail company. So looking at DKS on MarketSmith, shares broke out from a rare ascending base pattern in early March. The base held a buy point of 138.53. Shares passed this buy point in heavy volume thanks to an earnings report on March 7th that impressed investors. Despite the firm showing recent quarters of year-over-year declines in earnings, things are expected to pick up soon. Analysts expect EPS growth in 2024 of 12%. Meanwhile, the stock has been holding up strongly the past few months, with shares finding support at the 50-day moving average. So investors who think DKS will continue to rally and don't want to risk significant capital can use a long call option rather than buying the stock outright. This can be a good way to benefit from the upside gains while limiting your downside risk. A call option is a contract between a buyer and a seller. The contract gives the buyer the right to purchase a certain stock at a certain price, known as the strike price, up until a certain date, known as the expiration date. One call option gives the investor exposure to 100 shares. One of the benefits of call options is that they provide leverage. Assuming an investor wanted to buy 100 shares of DKS stock, they would have to invest around $14,500 at the current price. Instead, the investor could gain similar exposure using a fraction of the capital by buying a call option. So let's take a look at my trading dashboard and set up this trade in DKS.
So with DKS trading near 144, 145 a share, we could look to simply buy a 150 strike call with a September 15th expiration.
With DKS trading near 145 a share, we could look to buy a call with a 150 strike price and a September 15th expiration. For this trade, you only need to have around $1,420 rather than $14,500. The 150 call option has a delta of 51, which means it's roughly equivalent to owning 51 shares of DKS. The break-even price for this call option is equal to the strike price plus the premium paid, which would make the break-even price $164.20. The most the trade can lose is the premium paid of $1,420, which would occur if DKS finished below 150 on September 15th. However, if DKS shoots higher, the upside is unlimited. A stop loss could be set if DKS drops 8% from the entry point or if the value of the option trade drops by 40%. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money, and remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas, and join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.